Okay. Can you please do one more confirmation that you can see my screen? Can please somebody type that? Just want to make sure that everything is fine. Okay, great. Well, our friend from Australia is actually confirming he can see us. Amazing. Well, thank you guys for joining. It's a pleasure to hosting you. We've got webinar number 4, and as you know, in this at certain times we decided to provide as much value as we can. So we provide you with some market data, some thoughts on the current situation, and we bring some very special guests to you, so you can hear from the best of the best in the industry. So we'll start as usual. I'll give you a quick overview of several things that's happening lately, and then we're going to have an awesome interview with our special guest that is joining us from sunny Phoenix, Arizona. Okay, so just to start with, just a couple of words about us. We're CFP Group, to those who do not know us. The company stands for Cash Flowing Projects. We're based in Toronto. Between us, we've got more than 25 years of combined real estate investing experience. But if you include our partners, we've got well over 100 years of experience between all of us. We do projects mainly in real estate, projects in the real estate, in Canada and United States. Here you're going to get the link and the recording of this presentation. So if you want to see more about our projects, here's the link. At the moment, I've got more than 70 investing partners across the globe. Actually, we've got people in multiple countries. And type of the services we do project sourcing, consulting, we do mortgages financing, we do real estate coaching, and anything to do with the real estate buying and selling in Ontario. On top of that, we've got an investment community called Investors Inner Circle. At the moment, it's Ontario-based, and prior to COVID-19, we used to have meetings every 3 months. We'll see how it goes going forward, but as of now, we were hosting these webinars just to provide value to our community members. So briefly, several minutes, an update on some things I just wanted to share with you. So I wanted there's so much being said about COVID-19, so I really don't want to get into that. All I wanted to share with you is that some stats I was able to find, and some very, very interesting stats. So at the moment, you can see the table of cases of COVID-19 around the world. And Canada, you can see on the bottom of your screen. So as of this morning, we had a little more than 72,000 cases. Unfortunately, we had more than 5,000 fatalities in Canada, and the ratio of fatalities or death per million of people is 140. So this is as of this morning. Obviously, some countries are doing better, some countries are doing worse, but I wanted to show what's happening in Canada. So, and my main message is that the problem we face today is that we get notified pretty much on every case on daily basis, and it creates a lot of panic. So let's see some other stats I just prepared for you. There is something called influenza, which is typical flu, and there's 2 types of flu. There's influenza A, influenza B. And well, as I said a couple of months ago, nobody canceled other diseases. And as you can see on the screen, 2017, 2018, we had more than 55,000 of influenza A and B in Canada. And that's official statistics. You can see the source. It's IPAC, Infection Prevention and Control of Canada. And here's what's happening. This is from Statistics Canada. So if you take the influenza and pneumonia, the side effects of those two diseases, we can see on the bottom, on the right bottom of the screen, that in 2018, more than 8,000 people unfortunately passed away from those diseases. And if you recall, the numbers I just mentioned of COVID-19 is 5,300 as of this morning. And here's the ratio of the death. So in 2018, the death rate of people from influenza and pneumonia was 230 deaths per 1 million people in Canada. As of this morning, with COVID-19, we were at 140. So we're still nowhere near the typical, let's say, average stats for pneumonia and influenza combined. The problem is we get notified about every case with COVID, and nobody talks about the other diseases. So all I'm saying, unfortunately, we've got this counter, and that counter creates quite a lot of panic. I'm not saying not to take measures. It's very serious virus, serious pandemic, but just take a look at the numbers. Hopefully, it makes sense for all of you. Well, this is from today, from 1 p.m. Today, Ontario announced that we're going to start reopening the province, and phase 1 is going to be implemented starting from May 19th. So it's obviously like similar to other countries around the world. It's going to be phased approach. So phase 1 is going to roll literally from Tuesday. So we're going to catch up to some other countries that previously opened. And one of those countries is actually United States, our neighbors on the south. This map shows you the states that were open. That's the dark gray. Several states are planning to be open, similar to Ontario. That's light gray. And there are several states that still did not open. They're marked in yellow. But as you can see, most of the United States gradually they started reopening beginning of May, which is very, very good news, obviously for people, for economy. And hopefully we will not experience the second wave of COVID. On the economy and market reaction, the first webinar we had was in March, around end of March, and the market bottomed at that point of time. So just brief overview of where we stand today. You can see that the Dow Jones, which is one of the main indices in the United States, went up from the lows of 18,000 and roughly around 23,500 as of end of the day today. Still a long way to go to the highs of February, but a lot of ground has been covered. As you can see on the left side, the graph that it became sort of flat. On the right side, you see the graph for Canada, and we're also catching up, still well below the 18,000 that we achieved around February, but most of the negative territory, or at least half, has been covered. Now, I advised last time, and I still say we're not out of the woods yet. We might test the lows we established previously, so need to be very, very careful with the market, very volatile. So pay attention to what's happening. One funny, well, not funny, but very interesting story is that the NASDAQ, another index in the United States, and that's mainly tech index, came up to 10% within the highs of February. Obviously, lots of tech companies are doing great. And simply what's happening, people working from home, like using webinars, using Zoom and other technologies. So those companies actually having a very good, quarterly report in 2020. So as you can see, that is a reflection in NASDAQ. It went down a little bit this week, but they almost got all of the ground that was lost from February. Which is very interesting. And the next message I just wanted to show is that there's so much money that looking to be placed. It could be in different industries, including real estate. So this is an example from last week. Norwegian Cruise Line, one of the 3 major cruise lines, on last Tuesday, just announced that they need more money. Obviously, there are ships not sailing. Nobody's traveling these days. And the announcement that they made on May 5th was quite drastic. And it said there's growing concern that they would be have enough liquidity to sustain the pandemic. So the stock went down more than 20% that day. So that was on May 5th in the morning. On May 6th, less than 24 hours, what happened on May 5th, they said they're going to raise money by issuing more stocks and issuing more debt. So they're going to borrow money. Less than 24 hours, they announced that there's so much interest in what they have to offer that they're going to actually increase the amount of equity and amount of debt that they're going to issue. There was so much interest, so they actually oversubscribed. The second press release went the same morning about the increase in equity, and that was 5:40 a.m. At 8:30 a.m. the same morning, they said, well, we're done. there was so much interest. We got what we needed and more. And they planned about $2 billion to raise about $2 billion. They actually raised about $2.4 billion in less than 24 hours. And there was even more interest. So my message here is that unlike 2008, 2009, there's a lot of businesses, a lot of people with money sitting on the side, and they're looking to place. They're looking for deals. They're looking for opportunities. So for us, being real estate investors, this is probably one of the best times to continue capturing, because people, and especially institutional investors, they're looking to invest. They're looking to place their money to work. Okay, so we all need to use the opportunity to capitalize on that. So that's it for me. Just wanted to give you this quote. The distance between your dreams and reality is called action. So we never stopped during pandemic. We continued working. We actually worked hard, and that's the best time to act. The time of panic is the best time to find deals, to find opportunities. So we're here to provide anything we can, any value, questions that you've got. We're here to help everyone. Okay. So to start with the second part, I'd like to introduce two people. The first person, most of you know, it's a mentor of many real estate students in Ontario. I was one of his students. Somebody changed lives of many people, including mine, Ronnie Bukowski, and he's going to interview one amazing person I met more than 2 years ago. And he and his company, they're doing these incredible deals. You should have seen what they've done in the downtown Phoenix. So I advise you to listen carefully to what he's going to say, because people are following people with vision, and you're going to be amazed by the vision that Jordan and his company are having. It's just truly amazing. So Ronnie, Jordan, it's all yours.
Thank you very much, Michael, for very informative marketing update. We know there's a lot of information circling around, and making sense in all of it is very, very important. And you're a numbers guy, and Jordan is a numbers guy. He's an accountant. So I'm glad that I have these guys on my team to make sure that the graphs are correct and the information is clear to understand. So thanks again. Good evening, everybody. Thank you for joining us this webinar. Now, basically, what we can see, and after Michael gave the presentation, we can see it even clearly, that most of countries, or all the countries, have a need to get back to normal operation while creating a new normality. We don't really know how the new normality would look like, but we know it's going to change a bit. To all the golfers out there, it starts this weekend. They just announced Saturday. It's going to be a nice sunny day. So go out there, enjoy the outdoors, and work on your game. Recently, in the last, since this thing started, I'm taking the time to listen to experts, economists, and many real estate professionals to be up to date. And what we really see is a gradual rebound and comeback. And I think the important part to really see is consumer confidence. It always creates boom and busts. And optimism is in the air now. And with careful planning, we will come out of this deep freeze within a short few months. That's at least what everybody's saying. The conversation is really how fast. It's not if we're going to it's how fast things are going to get back to normal in different industries. In real estate, maybe things are less urban for a little while, but people will keep being people. Think about it, right? We miss our friends, we miss our families. I went to the park yesterday. It was full with people. Everybody said it's not allowed, but people need to travel, they need to eat out, and they need to socialize. We're, first world countries. We like those things. We need those things. In general, things will improve, I think, for the end user. Let's think about the work environment, and I think we're going to elaborate more with Jordan later on. Probably going to be more space in offices, at least for the next year and a half, until a really vaccine will come out. There's going to be more sophisticated air circulating systems, maybe cleaner air, maybe more elevators and multi-residential and office buildings, and other new designs. So I think overall the end user, the consumer, is going to get with much better experience from renting either office or retail or apartments. Just a small tip for those who want to travel, and I heard it from a capital house that gave a big presentation. All the very upscale hotels, although if you go to their website, they said that they're closed, they're actually open. And there's some phenomenal deals to be had. So if any of you want to travel and you don't have to fly, maybe that's the time to take advantage of those very luxurious resorts that we all want to go all the time. Our main business, as you already know, is in the mass debt and equity space. And today people are obviously more prudent. And my second advice, just for everybody, just keep your eyes and ears open because the opportunities are out there. And find the right niche, choose the right opportunities, just take action because we know the market will be back and we don't know if we're going to have the same opportunities 6 or 12 months down the road. Now, let's start a conversation with our guest tonight. Jordan Taylor is a partner in True North Studio, a development firm whose founders have decades of experience in commercial real estate, construction, development, finance, and accounting. And they've been involved in more than $6 billion worth of projects around the world. True North Studio comprises of a collection of talented professionals that hail from a variety of specialists, and they share a common goal to create and curate exceptional spaces where incredible things happen on a daily basis. And as one that attended their offices, their restaurants, their hotels, I can attest to that. Jordan, thank you for joining us. For patient. I think you love this video. Michael, can you check? Maybe there.
Hey guys, can you hear me? I'm here. I can see myself, but I'm not. Maybe you guys aren't seeing me on the other side.
As long as we can have a conversation, we'll send your photo and video and all the files that we have people after.
I think we're hearing echo though. It's from Jordan's phone.
Okay. Michael, I need you to mute the thing because there's an echo. So, Jordan, thank you, Jordan, for joining us. We really met probably 2 years ago, and immediately we realized how special True North Studio is. Successful development group must be true visionary, almost like a constant dreamer or philosopher. At the same time, with a clear plan and budget, benchmark, deliver on the time and on budget. You guys mastered it all. So good on you. So let's start talking. Yeah, there's a strong echo. I don't know. I get some. Michael, can you muted on your end?
No, I think it's
Yeah, mine. I'm not on the phone. I'm just on the video here. I'm not.
Okay. Oh, I think it's.
Better now.
Okay. I think there's echo on my end. Let's do that. Let me jump to Michael's office, and I'm going to use this computer to have echo. So, Michael, entertain the people for a second.
Okay.
Okay, done. I hope it's better now. Yes, I don't hear myself. So, Jordan has started to work on the Phoenix Downtown Master Plan not too long after the next recession hit. So you started the worst of time. Tonight we'll try to maybe a little bit about them, but also see what fundamentals you face as an accountant, as a developer, and thinking what's going to happen next 12 months. So let's just touch a little bit on the pre-COVID situation. True North Studio started to plan the redevelopment of downtown Phoenix. Start purchasing properties 2014-15 when the recession was still strong. So just elaborate on True North, your vision, why downtown Phoenix, and what you saw as a general creator of a big master plan for downtown Phoenix.
So I'm trying to. Can everyone hear me? Okay. I'm trying to mute myself when I'm listening, and then I'm jumping back on here to chat. Can everyone hear me? Okay, now that I'm talking. Okay, cool, awesome. So yeah, Ronnie and Michael, appreciate you guys. Not only business partners, but good friends, and fortunate to be here. I'm appreciative that you invited me here, and obviously thank you for all the hard work that you've done and that we've put in together over the last couple of years. So I appreciate that, and I think you guys have done an eloquent job of describing COVID as certainly there's a lot of the challenges that still exist. I'm an optimist, and I'm certainly seeing here in Arizona that we're coming out of things, but I do think there's an obligation for a lot of us to continue to make progress despite some things that are unknown, and the reality is there's going to be some unknowns for a period of time, but there are things that we can control, so we're certainly focused on those. Back to your question, Ronnie, about Phoenix, we back in kind of 14 and 15, as you alluded to, Phoenix was really on a kind of the early stages of a significant growth trajectory, one that's certainly continued up until all the things that have happened in the last couple months, and we're still optimistic that'll continue to happen kind of post pandemic, so to speak. But you look at the math, right? And again, you spoke to it. I'm a numbers guy. You look at the fundamentals. You look at job growth and wage growth, population growth, all the different things that speak to just speak to the trends that are compelling for certain asset classes. And the other thing that allows us to be different, and it's not a right or wrong thing. It's we're a reddish state politically that's lower taxes, lower regulation, surrounded by many blue states. And so whether you agree or disagree with the politics, there's been a natural progression from a lot of the bluer states where populations have historically boomed, where taxes and regulation have become burdensome to some people, not everyone, but to some people. And we have seen an influx, particularly from the state of California. We've seen a substantial influx into Phoenix. One of the interesting examples that I gave today to somebody else is one of my good friends who's selling their house here in Phoenix and looking to move to Texas for some job-related things. They've had multiple people come through their house that are doing 2-3 day trips out from different parts of California and planning to move out here for whatever the reasons might be. Maybe it's COVID related, maybe it's taxes related. So the point I'm trying to make here is I think we as a city and certainly as a state here in Arizona and in downtown Phoenix, even stronger than other parts, we continue to be very optimistic about where things are going into the future. And we're continuing to work hard to, as I said before, control the things that we can control.
Got you. Yeah, and you know what? I know that you're creating amazing things. Once things will stabilize, I'm sure that things will get back to normal pretty fast, because your product, as I know it to be, is done beautifully and really caters to the tenants out there and the hotel goers and stuff like that. So, talking about the COVID now, we're already 9 weeks into COVID mode, which basically shut down everything. You have developments in various asset classes. You have hotels, you have offices, you have new office, and you have repositioned office, and you have restaurants. So you're in the hospitality, you're in the real estate. And last time we spoke, I think, and maybe you can talk about it, maybe not. I think you can. You were in planning of building a residential tower, multi-residential tower. So you really threw out everything. What can you see in each segment really happen from let's say mid-March until now?
Yeah, I think we have such a unique perspective. A lot of people in real estate are focused on a specific segment or maybe a specific model, which works for some, and certainly in our context, we have a lot of things that we focus on. But there's a lot of things that are consistent across all projects. But we do have some overlap into different industries, Ronnie, to your point. And so, I think one of the topics that we covered a couple weeks back when we chatted is, we've seen a different impact, almost on a class by class basis. Certainly, some small differences between things like multifamily and office, and some larger impacts to the hospitality assets. Hotels and restaurants, of course, being the two main kind of subcategories there. So, I think the good news from our perspective is a lot of in Arizona, construction was deemed an essential service, which effectively means that any construction that was going on, as everybody I think here knows, continued to go forward. And, any projects that were, mid-construction, if you will, whether it was early in construction or late in construction, continued to progress, which I think was a really important thing for certainly for us as a company, but also for, a lot of the things going on in the state and certainly in the city. And so, from a construction perspective, we actually didn't experience any meaningful delays in the grand scheme of a larger project that will really have a significant impact, at least on paper today. So we were fortunate in that regard. Little things have happened along the way on some of those projects where maybe a tenant space that was in a retail environment, maybe they need 2 more months to open up now, kind of thing. Of course, all of that is certainly happening across all markets. So, in the context of development in a generic sense, in the context of even office product that we're working on, in the context of multifamily, that the stuff that we have right now is earlier in the stages of development, we haven't experienced any significant negative impacts. So we're fortunate in that regard. The flip side of that is we have a couple hotels across our portfolio, some of which you guys are certainly involved in. I think there's some that are here on the presentation, on the call today, that are involved in. So, the Cambria Hotel, as an example, we never technically closed down our hotel. Most of the hotels in the state did shut down. We kept ours open, and there are a couple reasons for that. One major reason was we do have a handful of corporate contracts that allowed us to at least maintain a meaningful level of occupancy to pay I call it a skeleton crew, but to pay a reduced staff and to maintain positive cash flow, even on a very minimal basis through this period, which I know most hotels can't say that. So we were fortunate in that regard. I think the big challenge with hotel coming out of this is, at some point here, we need to get back to 50%, 55%, 60%, and then, eventually to a higher occupancy so that we can achieve the goals that we had set out to achieve. So there's some challenges that certainly still exist in hospitality on the hotel front. On restaurants, restaurants are a whole nother animal. Restaurants in the state of Arizona did get, formally closed at the state level, and I think at a national level, with a few exceptions, they were shut down. And so, there was just a necessary requirement to shut down. Yes, there was some takeout delivery options. Some of that wasn't practical to execute. So, what we did do is we shut everything down. We were really adamant about keeping key staff in place. We did open up one of our restaurants recently for takeout and delivery. The state of Arizona just announced, and it was effective on Monday, the ability for in-restaurant dining to resume on a reduced level of about I think it's 25% occupancy, which for some restaurants is a workable model that can, for others it's not. So some restaurants have opened, others haven't. The one thing that happened from a government level, and this is something that if you've been following the kind of the political environment in the U.S. over the last several months, there's been a lot of legislation and new tax incentives that have been produced and made available to small businesses. So there was something called the CARES Act that was passed now a month and a half ago. As part of that, it provided several billion to $600+ billion of money for businesses with 500 and less employees. So that's how they kind of define small business, at least in their minds, at the federal level. And that money was made available to companies like ours that are certainly well under that threshold. And we were fortunate at a lot of the individual restaurant levels, at the hotel level, at operating level, to be able to tap into that that capital that was made available through taxpayer dollars kind of coming back to the taxpayers, so to speak. And it was a big help. So that's allowed for us to continue to keep the key people on board, even while we're still working to reopen things like restaurants and mitigate through some of these uncertain times. But In general, each state's a little different down here in the U.S. and I know in Canada there's a whole different dynamic. But in Arizona, I think we've been fairly fortunate.
Right. Well, it's very. It was a short question, very elaborate answer. So thank you. And the hotel segment really. I mean, I want to ask you, things that you've done, and you really answered that you applied for a lot of grants and loans, and you got them. But I'm wondering about new developments, and I've listened to a lot of webinar today. A big lender from LA, and he says, all the hotels are on hold now, and nobody's developing new. And then I saw, in Phoenix on downtown on 2nd Avenue, a new Hyatt just broke ground a month ago. And I'm thinking, are they crazily optimistic, normally optimistic, or the lender told them start using the money or I'm pulling it out? What do you think? It's kind of, if you need big balls or just you really think that in a market like Phoenix or Arizona, they may be different in other markets and people feel safer to invest now. Although it's 2 years down the road, but still to write big checks, it's a serious decision. What's your take on it?
So, it's an interesting question. I think the biggest challenges the hotel industry has faced in the moment are the ones that are operating, right? Because fundamentally they can't make money in this environment. It's virtually impossible. The question around development is a little bit more nuanced because you're going to get a lot of different answers. And, I think our perspective on it, and certainly my personal perspective is, if something's not going to open for a year, 18 months, 2 years, I think that's a reasonable amount of time for things to rebound and start to come back, particularly 2 years out. I think we're be in a far different place, and I think ultimately, a far better place, certainly. So I think as it relates to development, I would kind of lump hotels into three buckets. There's those that are operating today that are trying to get back open or stay open and eventually try to make money and get occupancy rates up. That's the biggest challenge in this moment. The second category being those that are under development and will open in a year or 18 months, as I referenced before. And I think those right now are fairly well positioned to get completed, to get open, and hopefully be successful. The third bucket, I would say, are ones that are kind of in that pre-development phase, early stages. Maybe there was still 4, 5, 6, 7 things that needed to happen for them to kind of get the deal closed and break ground. Those are getting delayed. I don't think there's any question about it. So you talk about capital and how it views kind of hotels is certainly generally there's some skepticism based on where the market is, but I think depending upon where the hotel is in the development cycle, the challenges in getting capital if you're completely unfunded are very difficult. If the capital's already there, I think a lot of capital partners are comfortable continuing to move forward as planned.
Right. Okay. Makes sense. Now let's talk about office a little bit, because office is really got hit, not as bad as retail or hotels, but, people are not coming to work, meaning the business can still make money. In our building, our office, we're sharing the building with a surveying company, and they're as busy as they are. You don't see people here, but they're out there and keeping busy. Now, we know that 15 years ago, the average size per employee was 250 square feet. This is including the boardroom and the kitchen and all that stuff. It shrank to just over 120 square feet per employee in the last 2-3 years. And we saw, at least in Toronto, in all the major markets in North America, Class A office was full, meaning all the big companies that tried to do remote work in the last 10, 15 years, kind of few years back, they decided that maybe this model is not great and start bringing people back. So on one hand, now you need, more square feet per employee. So maybe they need more space for at least 2 years until, a vaccine will come out. On the other hand, maybe they're going to start Zooming more and really having people work from home like it used to be up to 5 years ago. So it's kind of, you may need more office space, or maybe the new norm is really working from home. You have existing tenants and you have tenants moving in now. Is the COVID influencing how they lay out their people already in the new space?
So, it's a really interesting question, and you get a different answer from, if you ask 10 people, you get 10 different answers, kind of thing. And so we have certainly seen existing tenants and tenants that are moving into spaces. We haven't seen any significant changes to, at least from our perspective as the landlord. Nothing significant from a tenant relationship perspective. I think one of the question you're asking is around how the spaces will be configured and what's the space per office and those kind of things. And that's one that I think a lot of companies are still figuring out. Certainly it's true for us. We have not gone back to the office yet in a traditional sense. We're still all working remotely for the most part, with a few exceptions. I do think that one of the things that we think is important, that we're already starting to integrate into our existing product, but also our office that'll come online in 9 months, 12 months, and 18 months, are what I call them simple things that one could argue you should have done before anyways, but are certainly now top of mind. And I'll give you an example. One of our office buildings, which has Teddy Roosevelt's face on it, that's one that's almost fully leased up now. It's finishing construction over the next few months. Tenants are moving in. Some are already in the building, etc. There's multiple access points to the building. There's one specific access point to the building off the parking garage that there's virtually no non-office traffic that comes into that entrance. So one of the simple things that we're going to do is we're going to have a motion sensor to open the door and close the door, right? It's not expensive. It's an easy way for people to get in and out of the building without having to, quote unquote, grab the handle, right? Or even push a button for that matter. So just little things like that. The other thing that we're doing for one of our new developments is we're currently having our mechanical engineer effectively enhance the HVAC system to be more, I'll just call it COVID friendly. I know that term kind of sounds like an oxymoron, but you get the point, right? So just little things
COVID
that we can do that are not, yeah, it's more COVID unfriendly, exactly, which is a better way to say it. I'll use that one next time. But just little things like that we can do that don't, cause a real change in the budget. They're small costs in the grand scheme of things. And candidly, new tenants that are going to be moving into spaces are going to be looking for those small things to, it's going to be the differentiator from our perspective as a landlord, to make sure we have those small things in place and give people the comfort level and how they space their, how they spread their employees out and so forth will be somewhat case by case. But I think as a landlord, and that's certainly my perspective, is what are the things that we can do to help them to make them feel comfortable in the space?
Right. Okay. Great. Well, let's jump to the next segment. We're covering all the segments of real estate here, almost. Other than luckily, you don't have senior homes, so it would be very difficult to fill them today. That's for sure. Let's talk about the multifamily, and I know you're in planning to build a multi-res tower. Now, I don't know what stages you are, if you're in design stage. So first, if you can share a little bit more about that, and also if any design changes because of the COVID started coming to mind. One thing that I heard from some people is that, maybe again, more elevator or kind of less common areas, more like, as you say, friendly ways to get in and out and stuff like that. So where are you standing with your projects on that?
Yeah, so that's one that we're in a very similar timeline as one of the offices we're building now. A little bit, office a little bit further ahead, but effectively we own the land, we've designed the building. It's now just a matter of getting under construction. And so the goal was originally to break ground in July. That's not going to happen just given COVID. So we have experienced some some shorter term delays on the construction side. We'll probably break ground in September, October at this point. But a lot of the same principles that I spoke about before with the office product are certainly true, and just how we ventilate the building. These are not things that cost a significant amount of additional capital, and oftentimes it's negligible. So the HVAC is a really big one. It just is, and the ability for elevators and doors to be operated without people's hands touching them all the time. Those are not significant things but they're just now top of mind. They're important to people. And so, a lot of those things a lot of the design and the architecture of the buildings as it relates to multifamily as well. We're not, we haven't planned yet to make any substantial changes. Certainly there's going to be more protocol around some of the common areas and so forth that we'll determine as we get further along in construction. But from a design development kind of construction perspective, some of those simple things that we can do around, air circulation and, human circulation, for lack of a better term, are the things that we're focused on.
Right. Yeah, I agree with you. The HVAC is a huge factor. At least, as we say, it's all consumer confidence, right? It's also ecological. Nobody really says, you get an expensive HVAC system, all your tenants will be COVID-free, right? But they will feel more confident to come to your building and visit your
Yeah, no doubt, Ronnie. And the other thing that I would add to that is, if there's a percentage of the population, whatever that is on a state-by-state basis, country-by-country basis, that, has been, has come down with COVID, as, whatever the case might be, and obviously there's a lot of challenges that have gone with that. If we can create a building that it reduces that, who may have been infected by 10%, 20%, 30%, whatever it ultimately ends up being, then those are little things that we should just do. And I think, again, there's so many unknowns, it's impossible to quantify it at this point. But, certainly, again, if you can make little changes that, if they happen to be better for things like COVID, then they're probably better for a series of other things as well, right? From a disease and sickness perspective. So I think it's conceptually, for me, it's like recycling. It's like, just throw your damn plastic in the recycle bin, right? Like, it's not hard, right? It's anyway. So it's stuff like that I think we can all get behind some small modifications to our real estate.
Big changes in the market always creates new opportunities. And I think, you remember the way of LEED certified building, the green building and all that stuff. I see COVID certified building all over the place. You're going to have consultants who specialize in that and make so much money. So new businesses will come out of this thing for sure. Let's talk about construction costs a little bit, because I know Arizona was very tight with labor material because it was very, very busy. I heard today a few projects in California, in other countries, in Chicago, that projects that are about to start to be built, and they went back to the GCs and told them to sharpen the pencil. And because of the fear that they will be not as busy, they actually either squeeze down their subs or actually making less money. And I've heard 5 to as much as 15% cost reduction. Do you see that in Phoenix happening as well?
Yeah, my favorite story, I'll tell this real quickly before I jump into that question, and I'll make my answer quick from there, Ronnie, for you. But one of our subs came to us as soon as this hit, and he said, I have to increase my prices by 30%. And we're like, why? He's like, COVID. And it's like, okay. So anyway, I like to joke about that, because it was of course we didn't agree to it, but we thought it was like, hey, at least he tried, I guess. I don't know. But no, look, your math is spot on, right? 5 to 15%. I think we've seen across our projects. Every project has experienced a minimum of 6 or 7%. Most of them are in the 10% range as far as what we've been able to capture, from a development budget perspective. So spot on. Construction costs have come down by, right in that range, depending upon the state. Arizona's in that 10% range.
Okay, it's bad for the contractor, it's good for the developer. So it's a pendulum, right? They squeezed big time before, so now they have to make less, and that's okay. Well, as a numbers guys, you're an accountant and you follow economics. The unemployment rate is really a big number and a big factor, and it ties to the consumer confidence. It's now at 14.7%, up for sub 4% in March. The top of the market 2010, I'm talking national USA, was 9.6%. Looking at these numbers, how fast you think the unemployment rate will be in a manageable territory again? Let's say in the 6 to 7% range, which is kind of employed market, and you see the potential growth. What are your thoughts on?
Yeah, it's a obviously we've never seen anything like this, so it's impossible to compare how quickly unemployment has risen to really any other example, even the last the last crash where it took time for everything to happen the way that it did. So I think everybody's aware that a significant amount of this unemployment is tied to hospitality, that restaurants have been forced to be closed and retailers have been forced to be closed. So, Ronnie, you've talked a lot today about consumer confidence. I think consumer confidence is critical. I think it's going to be the driver around unemployment fundamentally, because a lot of the folks that are becoming unemployed are the ones that are in those spaces where consumer confidence drives virtually the whole segment of that market. So, my personal opinion is that, it's going to be very different state by state in the U.S. Again, I've spoken to some of the things about Arizona that we feel optimistic about, but, I think the longer it takes states to open, I think, again, maybe that's the right thing to do. And I certainly can't speak for every state's different, every, demographic's different. So there's no perfect answer here to get back open. But I think as the longer it takes a state to open, the harder it's going to be fundamentally to rebound as fast or as quickly. And so I'm hopeful that, as a country, we start to rebound, and certainly for you guys as well in Canada, I'm hopeful that, things rebound quickly. I think the states, sorry, I'm outside. I have a friend bothering me here.
Listen, I'm enjoying the songs there like crazy. I'm sure
can you hear him? Yeah, it's awesome. Hopefully it's not too much of a distraction here, but so look, I think in states like Arizona, in order to get unemployment back to a reasonable number, my personal opinion is that it's at least a year. So some people are saying 6 months. I think it's at least a year. I think it's 12 to 18 months. If I had to bet, it's going to fall somewhere in that range. So I think we have to all be prudent, practical, level-headed for the next kind of year to 18 months. And coming outside of that, I think we'll be in really good shape. But in my opinion, that's the period of time.
And I think really tied to as a landlord to the class of building that you have. Are you in the A, B, or C class? And as you said, C plus, B minus. These are the hospitality retail guys that work. They're full time, but not a lot of benefits. They need to make money to pay the rents. So I'm sure landlords in that segment are suffering more. I already starting to see actually a few buildings that are offered with a lot of government subsidies and incentives, Section 8 similar. So I think if you're not a Section 8 landlord in that marketplace, you're going to be hurting big time because, in good times, it's very challenging to collect rent in those areas. In times like that, it's probably more difficult. Now, many of your investors, they're sophisticated investors, they're accredited investors, they're in family offices. And conversation that I had with all those guys about a month ago or something, everybody says, listen, we're waiting for, as we say, blood in the street, right? We're waiting for the deals to come. I have to say the last week, 10 days, the conversation, it's like, you know what? We don't think there's going to be a lot of blood. We might as well start looking at the deals that we looked before. If an opportunity comes, yes, we'll take over. But people are not like in 2008 or 9 and 10 that knew that the deals will be there. In your level, with the level, your developments, each one is like, in the tens or hundreds of $1 million. What do you see? Are you looking for other niches development? And who are your investors with the heavy capitals? What are they telling you these days?
The concept of opportunities being there is, I think, on some level there's going to be. There always is, but I think there's going to be an elevated version of that for some period of time. I would agree that it's nothing like 2008, 2009, which is a very different beast. But I think our perspective, kind of looking at it from how we've approached real estate and development from the beginning, and looking at maybe some of our peers or other folks that are doing similar things. Look, the people who are going to be affected the most and may be the ones that provide those opportunities to others, at least from someone coming in and taking things over or whatever the case might be, are the ones that were probably overextended already, right? And what we have seen relative to our relationship, certainly on the banking or on the lending side, on the debt side specifically, is they know where we're at. They understand our liquidity positions. They're willing to work with us because they know they're not in a dire situation, right? I think lenders, if they look at something and say, I appreciate you're asking me for help during COVID, but things weren't pretty before, right? So I think there's an inherent additional risk to those who maybe had some challenges going on previously, and they really needed some good things to happen to get through the next X number of months, and COVID maybe is going to drive them to those more difficult scenarios. I think developers and real estate investors and so forth that are properly positioning things and having reserves in place and being prudent about knowing that the future always has downturns. It never goes up forever, and so we're in the middle of an extremely unique time. But downturns and blips on the radar are nothing new, right? And so you have to be prepared for whatever the version is of that, anyways. And so, again, I think that's my perspective on that. I would tell you that some of our investors have come to us and said, look, there's capital that we have, and if you guys think there's an opportunity that makes sense to maybe step in someone else's shoes or whatever the case might be, like, we're open to that. I don't think we're actively seeking those out. Certainly we're not, and I don't. Many of our relationships haven't brought things to us and said, hey, let's go try to take this deal over or do this deal. So I think it's still a short enough amount of time. You think back to the whole 08-09 analogy that we keep talking about. There was a long period of time up until the blood was on the streets. It wasn't 2 months, right? And so people had the opportunity to really do proper analysis, understand where the opportunities would be. There was clarity around the economics and the foreclosures and things that were happening that allowed for people to build a business model or a plan around, capturing those opportunities. I think it's not, we're so early in this phase in the grand scheme of things. I think it's a little more difficult to do at the moment.
Right. Got you. Now, you said that, capital guys coming to you looking for opportunities. Are you looking for something different today that you looked before? Like people talking about, the last mile distribution centers. Amazon is buying AMC maybe just for the real estate and the warehousing. Are you looking at and things like that? Did it change your perspective, investment?
I would tell you our perspective, since this is all happening, has been let's control what we can control and let's do the best that we can with what we have, right? And certainly if opportunities present themselves, we'll talk about them, but we have not been actively seeking, what else? You know what I mean? Like we have enough going on and enough things that we're committed to doing a really good job with, that we're focused on, making sure those are as successful as possible. And so, to your point, we have had some people reach out and talk about other opportunities, but to answer your question directly, no, we haven't looked at, let's do warehousing because Amazon's doing more delivery. We haven't gone down that road.
Okay. Well, there's, as you say, we're so early into it. We know new consulting job will come out, better HVAC systems will come out, but we don't really know where the new segment of the market is going. Maybe retirement homes will change their ways, but I think you're continuing to do what you learned and were able to accomplish in the last 5 years is the right place to be, because as you said, the real estate, especially the development, is not like overnight. It's not buying stocks in the morning, selling in the evening or within a week or within a month. If you don't have the 20-year vision, you don't start developing it at all. So it's a bump. Let's get over it, and that's it. So I think, I have many more questions, but we'll keep it to when we get together with a cold beer and talk about other stuff. But I think that we covered a lot of topics. You gave a lot of information about, the different segments and definitely your market, which, as you said, every market is unique. Even in Arizona, there are markets that are still strong and markets that are hurting with or without the COVID. So very, dig down into the market, know it well, and cater to the market is something that I really appreciate you guys for doing perfectly. Let's open the chat box if people have any questions. So feel free to ask questions, and if not, I will ask a few other questions. So Ian and some other guys, that's your turn to ask questions. So please. Okay, I think I'm someone is typing. Sean, Ian, see who's the winner. The winner gets a copy of Jordan's book. Ian, that's it? That's your 2 cents? Okay. Jordan, you get a lot of compliments for your beard, so good job. And Ian, you should wear your glasses, because the way I see it, it's a bit different. Sean is asking, what do you predict with residential real estate? Again, this is more you don't act in that marketplace, but you know it well. Do you see any higher foreclosures, or what do you see there?
Yeah, so look, I think one of the things that we've seen as a macro trend across residential has been, at least here in the States, has been a trend from home ownership more to the rental model, right? And a lot of people who have historically, you go get your job, here we call it people refer to it as kind of the American dream model, right? Where you get a job, you own a house, you have a yard, all those things, right? And so I think we've seen a trend away from that historically anyway. So I don't see residential real estate in a transactional sense as it relates to, primary home buyers, et cetera. I don't see that market increasing. Certainly, I didn't think it would before, but I think this only validates that that'll probably even continue to tick down. I would say, the multifamily space is a little bit interesting, because you talk about unemployment and you talk about, numbers at 15+% going up and how long it's going to take to get back. Well, the reality is most of the people that are unemployed are also renting, right? And so now there's an inability for some portion of the population, whatever that is, they're unable to pay their rent. So I think you're going to start to see some certain types of residential products, maybe as Ronnie referred to it, based on class. Maybe it's it's the B and the C and the D, whatever they are. Maybe you're going to start to see those struggle a bit more, because there's a gap in rental income tied to some of the unemployment numbers. But other than that, I think as it relates to the single family home market and so forth, I think if you're a great realtor, you have great relationships. If you're there's certain neighborhoods that are always going to be popular. If you're great at what you do, you're always going to do well. There's always going to be people buying and selling properties, whether they're primary owners or investors. So I don't see a substantial change in the single family home market. And again, but I'm certainly not an expert on it either.
Right. Well, again, it's back to I think not consumer confidence, but also bank confidence, because here when it all started, the bank said, talk to us in 90 days, maybe in 180 days. So they didn't put the sword on your throat, which didn't happen in other crises, right? I mean, the correction was immediate. Okay, any other questions from the participants? I will ask until we have another questions. I heard, again, on the multi-res about tenants, people talking maybe about de-urbanization, because, in the last few years, especially you see it in Phoenix, right? Everybody wants to be downtown because there's a reason to be downtown, right? I mean, there was nothing downtown. There's a lot of things. You build a lot of it, but there's a lot of restaurants and venues and maybe now people say, we don't want to be close to other. Maybe we want to move out to the suburbs for 2 years, commute again by car, and maybe reconsider in 2 or 3 years down the road.
It's an interesting dynamic, right? As we start to urbanize, now we de-urbanize, right? Yeah, and I think one of the things I didn't speak to before that I do think has been helpful for Phoenix and certainly Maricopa County and kind of Arizona in general relative to the coronavirus is we are still fairly spread out in comparison to most major cities. If you look at, you know, a lot of the, you see where a lot of the concentration of this, a lot of the challenges have happened, and it's where people are closer together naturally, right? So, you know, I think Phoenix and Arizona has a natural infrastructure that allows for moderate density and allows for people to pick and choose, right? I do think there's plenty of people that are going to be very comfortable in an urban environment. Arizona is well situated to achieve a suburban or a spread out environment if that's your, if that's your cup of tea as well. So I do think that's a valid point. I guess I don't have a strong opinion on it at the moment relative to deurbanization, but you know, if anything's working for Phoenix, I guess, which is where my brain tends to fall back to, you know, we already have the infrastructure to accommodate that.
Right. Okay.
Ian
is asking about if you moved into 1001, and I think you had a different higher rent. Feel free to take it here.
Yeah. The short answer, Ian, is no. The long answer is we have two separate. So the remaining floors that are not under lease now in the building are 5 and 8. We actually have two separate LOIs that we're negotiating and hoping to finalize very soon to have a 100% occupied building. So the likelihood is, assuming one of those, one or both of those go through, will ultimately allow the tenants to pay a little bit more rent than we were going to otherwise, and kind of keep our footprint between a couple other properties that we own right down the street. So
plus as a landlord, the worst real estate opportunity, not the best. If you have any basement that you can rent, that's where you should be. Any other questions? I saw Sean wanted to ask something. Michael, do you have anything to ask? I know you asked me a few questions, and maybe
I do, but we crossed 1 hour time, so I think we can keep those questions for the next interview, Jordan.
Okay. Here, Sean asked a question. Let me just read it out. With regards to, where is that? With regards to early development phases, he just closed on a property. In this current situation, how difficult will it be to acquire building permits from the city for
So the short answer is it shouldn't be. We haven't seen any meaningful changes now that there was some temporary delays while, places were being shut down and people had to socially distance and so forth. But as we've now, and even during that, we've been able to keep progress going. I know a lot of other people that are in rental and doing a lot of multifamily and single family stuff. And I don't think there's any significant risk, at least in this market, to, permitting.
Yeah, I know it's really city by city and how efficient they are. And I know the city of Toronto is horrendous. They closed down the planning. You can't talk to anybody. Forget about it. Committee of Adjustment, forget about it. Some other markets very early on moved on to online platform. Sometimes there's hiccups. We have a project that after submitting everything, they made a mistake and they deleted all the files, included all the pre-consultation notes. So we have to go and figure it out and prepare a new file and submit it again. But it really, again, I don't know if Sean is asking about Canada or the US. It's city by city based, and maybe they will move to online later on. I heard a law firm from California today that what they do is they do the entitlement process for all their clients. And they're talking that many cities said that they would reduce, because of this situation, their staff by 25%. So I think, boom of construction, less staff is going to make everything a little bit more challenging. But again, part of due diligence was always to especially on developments. And Jordan, you guys know how important it is to have great working relationship with the city and to know exactly what they're looking for. And not fight with them, just work together. And some cities from the get-go are not friendly. So COVID will bring, I think, another level of complication to see if cities are really ready and build out to process permits fast. Okay, we'll have one more question because, as Michael said, we're over the 1 hour mark. It's difficult to be acquired building Marin City for rental apartment in Canada. Sean, you can call us if you want. We can talk. We'll give you my 2 cents on markets here in Canada. No, I think that's it for now. So I want to again thank Michael. Thanks again for the fantastic market update, and Jordan. Thank you for your time, your experience, and sharing it with us, and having us enjoy your beautiful face and also your beautiful sounds from out in Phoenix and your jungle out there. So thank you.
Thank you so much.
Yeah, thanks everyone. Appreciate it. Thank you, Ronnie and Michael as well, and enjoyed the conversation.
Okay, good luck, and let's just wait to get out of it and get back to golfing. Have a fantastic evening, everybody.